Hey, what's up, my friend? So in today's video, it's all about ATR Indicator Secrets, right? ATR stands for Average True Range, and I'm going to share with you, right, or rather you'll discover, right, some really useful, profitable trading techniques that you can apply to your trading, and it's stuff that you might not have seen before, right? So specifically, here's what you'll discover today. Number one, how to use the ATR indicator to identify explosive, right, breakout trades about to occur. What's the one thing to look for, right? The ATR indicator, it will tell you. Then we'll talk about how to actually, predict, right, market turning points and identify potential high probability trend reversals ahead of time. Number three, how to set your stop loss like a professional trader, because I know many of you, right, always you set your stop loss, the market hits your stop loss and then reverse back in your original direction and you feel, why is this always happening to me, right? Don't worry, the ATR indicator can solve that problem as well. It helps you to avoid that stop hunting scenario. And finally, you'll discover, right, how to use the ATR indicator to write massive trends in the market, right? The type of trends that other traders can only fantasize or dream of. That kind of trends, all right? So sounds good, right? Then here's what I want you to do right now. Hit the thumbs up button and subscribe to my YouTube channel. The button is all below. Hit the thumbs up, subscribe to my YouTube channel, and this way, whenever I publish a new training, a new video, a new strategy, a new technique, you're always updated. Never miss anything from me again, right? So do it right now. Hit the thumbs up button, subscribe to my YouTube channel. The button is below, and if you've done it, then let's get started. So now you're wondering, right? Hey, Rainer, how does the ATR indicator work? What is it, right? So the ATR indicator, okay, it's a volatility-based indicator. It measures volatility in the market. And how it works is it's calculated using, one of three methods. I'll explain why there are three later on. But first, right, the three methods are this, right? The first method is current high minus the current low. Second method to calculate it is the current high less the previous close or minus the previous close. And the third method is the current low minus the previous close. Now, right, why there are three methods? The reason is simple. It's because of the way the charts can form. For example, okay, if the first one you get is, let's say, a bullish engulfing pattern, you go with method 1, right? Let's say image A. Method 1, current high less the current low. This is the high minus the low, and this will give you the true range of this market that you are looking at. If, let's say, you have a bearish engulfing pattern on your chart, so what you'll do is you take the current low, right, minus the previous close to give you this range over here. So that's how you actually calculate the true range on your charts. So why is it called average true range? Is because once you calculate all the individual true range candles value, you then divide by, let's say, 20, and that's where you get the 20 period ATR. Does it make sense? Okay, so if this doesn't quite sink to your head, just pause this video, analyze, and you'll kind of understand where I'm coming from, right? I might be a bit fast, but because I don't want to waste too much time on this, the concept is very simple, right? So let me just, if you don't want to find this out yourself, right, let me just break down the concept simply. The concept is this, is that the ATR indicator, it measures volatility in the market. This means if you notice the range of the candles is getting larger, your ATR value should increase, okay, because it measures volatility in the markets. So notice range of the candles getting larger, ATR indicator value increase. So now what about range of the candle is getting smaller? What should your ATR indicator show you? Well, it measures volatility, so your ATR value should decrease. Okay, so once you understand this concept, you're good to go. This is all there is to the ATR indicator. It measures volatility in the market. Okay, so if you don't want to, understand the calculation, just know this one thing. This is important. So moving on, right? How do you use the ATR indicator to identify explosive, right, moves about to occur, right? The secret is this, is that before I share with you, right, let me share with you how the market moves. So market, they moves in cycle. It doesn't, move in one straight line. Sometimes the market breaks out, it goes very aggressively in one direction, right? It trends and trends and trends, and then it will take a break, right? It rests. Right? So something like this. Okay, let's say the market breaks out, trends, right? Volatility is high, and then it needs to rest, pause, right? And then it makes another move, either higher or lower, whichever. But the key thing that I want to share with you is that the market moves from a resting period, right, to a huge moving period. So in other words, right, what I want to say is that the market moves in different volatility cycle. It moves from a period of low volatility to high volatility, and then back to low volatility again. So the key thing, right, the secret, right, to identifying explosive breakout trades that are about to occur is you want to identify low volatility period. And here's what you can do, right? You want to identify multi-year low volatility, right? And usually I look at it on a weekly time frame. So this means that there is a more potential move to catch, a bigger wave to ride, a bigger trend to catch. Okay? So let me share with you an example. A few examples actually. So if you look at this crude oil weekly time frame, right, you can see that, look back, notice the price action, notice the value on the ATR indicator, which is this line over here. It's trickling lower down to this point over here. And at this point, right, it's at multi-year lows because volatility on crude oil at this point in time, which is about June 2014, is at multi-year lows. And if you look at the chart, what do you see? You can actually, plot out basic support resistance level over here. Somewhere about here, possibly one more here. Okay, so you can see that, hey, where's my ATR? It's missing. Okay, let me just some bug. Okay, it's back. Okay, you can see the ATR indicator, multi-year lows over here. So one way to trade it is that if the market breaks out of a key level, a key market structure like support or resistance, right, you can trade in the direction of the breakout. Because remember, right, I just said, right, that the market moves from a period of low volatility to high volatility. So now it's in a low volatility environment. So if the market, let's say it does break of support, okay, you can look to short this market, right? And in this case, on hindsight, a cherry pick chart, the market did collapse lower pretty badly. So I don't usually trade off the weekly time frame. So what you can do is that you can apply multiple time frame analysis. So let's say the weekly price is break below this key area of support. The volatility is really low. So what you can do is go down to the daily time frame and look for a tradable trading setup. Setup that how to trade, like a bear flag pattern or prices at resistance, etc. So in this case, okay, price, you can see, right, it break below this area of support. So you can see there were ample opportunities to short this market. You could have shorted on the bear flag pattern over here, maybe even here, or even over here. Okay, or even if you go down to the lower time frame, like the 4-hour time frame, it might even be possible to short at resistance of this swing lows. Okay, so the key thing is to pay attention to multi-year low volatility on the weekly time frame. So another example, all right, let me share with you just one more. Euro dollar weekly time frame. So again, let's identify multi-year low volatility. In this case, you can see that over here, volatility is at multi-year low, right? Very, very low. Again, so let's look at the chart and see if we can identify any key market structure. Okay, there's one like a upward trend line. Okay, let's just draw this briefly. Possibly something like this. Okay. And after which you're going to draw another support resistance level. I would say this would be another key level to pay attention. So I would say this over here will be a more obvious market structure, right, where it breaks the trend line as well as this area of support. So again, at this point, look at the volatility of the market. Multi-year low. Right, so when the price breaks below it, again, you can look to short. As mentioned, you can go down to the daily time frame and look for a possible, or rather a trading setup that you recognize. And one of the easiest ways is just to trade the flag pattern. It's like a trend continuation pattern. Okay, so if I were to just look back and share with you, see where you could have traded this. Okay, so this was the break of trend line. You probably won't short on the break of trend line, right? But over here, when the price it break below this area of support, right? Possible bear flag pattern that you could have, shorted here or even here. But you get my point, right? Low volatility environment, right, leads to volatility expansion sometime in the future. Okay, so that's the first thing, right, on how to use the ATR indicator to identify explosive breakout trades about to occur. Second thing that I want to share with you is how do you identify high probability trend reversal using the ATR indicator. So one thing to share, right, is that the market, right, each and every day or every week or every month, right, the market tends to move in so-called fixed amount. There's like certain amount of potential energy for the market to move, right? So for example, if you are looking at, let's say, euro dollar, the daily time frame has an ATR of 100 pips. What it's telling you is that on average, each day, the euro dollar moves about 100 pips. That's the average daily range of euro dollar. Okay, so if sometimes you notice that euro dollar has moved 150 or 200 pips for the day, chances are it's not going to go and hit 400-500 pips. It could happen, right? Maybe because of a news event, right? But more often than not, if it reaches 150, 200 pips, the market tends to snap back in the opposite direction. Okay, and you can use this this knowledge, right, to your advantage and trade the trend reversal. How you'll do it is this, right? You want to look for the market that has moved more than 1.5 times ATR into key market structure. So what I mean by this is, let's say, for example, market is in a range. Okay, market is here. And at this point, market is closed over here. Let's say, again, let's talk about euro dollar. Average 100 pips a day. And let's say today, euro dollar has moved 200 pips, right? Bullish candle, smack into this area of resistance. You know that at this point, right, there's a high probability of reversal because number one, euro dollar came into resistance. Number two, it has, exceeded its daily ATR by more than 1.5 times. And number three, if you can get some form of a confirmation like a shooting star, bearish pin bar and stuff like that, it really, right, would sweeten the deal and, give you a high probability of, trading this reversal. So let me share with you a few examples again. So moving on to the charts, okay, so let's have a look at, this one is NASDAQ. All right, the NASDAQ recently we have a very steep sell-off, right? So again, let's look at the monthly time frame. Okay, so this concept can be applied whether you're trading off the daily, weekly, or monthly, right? It can be applied the same. So if you look at NASDAQ, right, pay attention to this candle over here, the most this bearish one. If you look at this range of this, okay, let me just move over here, right? At this point, right, this is the current ATR value, which is about, let's make it 475, right? 475 points on NASDAQ. So this means that on average, right, each month the NASDAQ tends to move about, 475, 500 points. So the next candle, right, you have this candle over here. So this candle, right, the range of this candle is from the high to the low. It's about 7139 minus 6352, right? So 7139 minus 6352. That's about 780, 790 points. Okay, so that's about more than 1.5 times ATR for this particular month. Okay, so this tells you that, hey, this market has moved more than its usual amount, right, in terms of average true range. So what you want to do is then pay attention, right, on the lower time frame and see if it come into, any key market structure. And if you look at the weekly time frame, you'll notice that this market, this price, right, at this point in time, right, this is where it made the largest swing, about 787 points on the monthly time frame. And the next candle on the weekly time frame, you notice that the price has actually, break and close back above this area of support. So there's three things going for you right now. Number one, the monthly time frame has hit 1.5 times ATR. That's the first thing. Number two, it's at this area of support. And number three, you have this bullish higher close. Let's call it a higher close, right? A price rejection back above support. So this tells you that there's a good chance the market could possibly reverse higher because you have quite a number of factors, right, in your favor. So this is what I mean by how you use the ATR indicator to so-called identify trend reversal. Okay, in this case, the market had quite a nice bounce. One more example. So let's have a look at copper futures. So same thing. Okay, this one has a bit of a gap. Let me just find a better chart. Maybe a CFD one might be a smoother. Now this one is okay. So you can see over here, same thing. Find out what is the ATR value. My ATR loves to play hide and seek, right? Come out, wherever you are. Okay, there it is. So again, copper, look at this. Notice there is this key market structure here. The range of this copper candle. Why is the ATR indicator running away? Okay, so let me just pull it out, this bugger again. Come on. Okay, it's here. Okay, let me just find out what's the ATR value. It's about 0.133. Let's make it 0.13 to make it easier on myself. Okay, so average ATR value on the weekly time frame for copper is 0.13. Okay, and find out what is the range of this particular candle over here. Just take the highs minus the low, and you know what is the ATR for this particular candle. Okay, the range is about, let's see. High is about 3.31 and the low is 3.09. So that's a difference about 23 cents. So again, it's about more than 1.5 times ATR. So again, if you go down to the lower time frame, okay, and you can notice that over here, notice this, right? Price, this is the range. The huge burst of momentum you saw on the weekly time frames from here to here. Okay, so over here, right, there's a price rejection on the daily time frame. Number one, you saw earlier that for the week, right, it has hit, right, more than 1.5 times ATR. Number two, you had this resistance R. Number three, you have this bearish pin bar, right? Basically a shooting star, or basically a price rejection. So this really, gives you, right, strong, rather a high probability, right, that the market is likely to reverse lower because there are these three factors, right, coming into play. All right, so I hope you get my point, right, of what I'm trying to share over here. Obviously, this is a cherry pick chart. I won't be an idiot to share with you a chart, right, that goes against what I just teach. But bear in mind, whatever I shared, all my YouTube tutorials, there will be losing trades. Definitely, I guarantee you it. Okay, so don't forget that, and don't assume that everything I share is going to be 100% win rate. That is ridiculous. Okay, so that's to sum up, right? How you identify high probability trend reversal. A market move more than 1.5 times ATR into key market structure. It can be a trend line, support resistance, right? And then, followed by a price rejection. Okay. Third thing, how do you set a proper stop loss so you don't get stop hunted? So here's the thing, right? A lot of times, traders, they like to, set their stop loss, right, just above the highs and lows of market structure. Let's say the market comes down, dip a little bit. Oh, let's go short. Stop loss above this highs. The next thing you know, market goes up higher, poop, hits their stop loss and reverse lower. Okay, so what's the lesson over here? Number one, don't set your stop loss just above resistance or just below support. Okay, instead, what you want to do is to give it some room to breathe, right? What I suggest is to identify the market structure first and then set your stops away from market structure. That usually, right, ensures that you won't get fake out too easily. And some of you have a tendency to use fixed stop loss, and this is something that I don't suggest as well. Two reasons why. First reason is because different markets have different volatility. What this means is that let's say 100 pip stop loss might be enough for a market like dollar Canadian. But 100 pip stop loss won't be enough for a market like the pound yen, right? Let me just show this to you. This is important, right? Many times traders make the mistake of having a fixed stop loss because it's easy for them to calculate, but it doesn't make sense. So if you look at dollar Canadian daily time frame, you can see that right now, okay, it has about 75 pips, right, as it's a average true range per day over the last 20 period. If you look at the market like the pound yen, okay, it has an ATR value of about 174 pips. So can you see that different markets, they have different volatility? So this is why, you don't want to be using a fixed stop loss. It doesn't make sense. Market, they have different range each day, right? For the Forex market, for the stock markets, it's all the same. Another reason why you don't want to set a fixed stop loss is because, right, depending on the time frame you trade, you might need a larger or smaller stop loss. Again, for example, pound yen, right, daily time frame has an ATR value of 174, 175 pips. But if you're trading off the 1 hour time frame on the, let's say the 2 hour time frame on the pound yen, notice that the ATR value right now is only about 28 to 30 pips. So if you were to use the ATR value on the daily time frame and apply it to the 2 hour time frame, it's overkill. It's overkill, right? So it's like taking a machine gun to kill a chicken. It's overkill. All you need is a knife, okay? So bear this in mind, and this is why I said that you don't want to use a fixed stop loss, right, when you are trading. Instead, what you want to do is identify, step one, the market structure. Can be support, resistance, trend line, pivot points, whatever. And then set your stops away from the market structure. And how you set your stops away from market structure is you can use the ATR indicator, right? You can use a 1 ATR away, 2 ATR away, depending how conservative you want to be. So let me share with you a few examples, okay, to illustrate my point. So Euro Canadian. Let's look at this one over here. Let's look at the daily time frame. So you can see over here, this is what I was saying. Let's say, traders will look at this chart and say, oh, there's resistance. Okay, let me just draw my level, right? Oh, price, previous support, then resistance. This is a resistance. And at this point in time, right, look, Rainer, there is a bearish engulfing pattern. Woohoo! Let's go short. So they go short. Where do you put your stop loss? Textbook says put your stop loss above the highs. But you're smarter than that, so you go and reference it above this highs. Then what happens? Market just come up, eat your stop loss alive, and then reverse down lower, which is what I just said to you, right? Don't set your stops above the highs or below the lows. Don't just set 1-2 pips below or above it. So how do you do it, right? Again, ATR indicator. This bugger went missing again, so let me pull it out. Okay, so again, pull out your ATR indicator. Find out what is the current ATR value when you are about to enter the trade. So in this case, the ATR value, it's again, to make it easy, let's say 115. Let's make it 115 pips. So what you'll do is just take the highs over here, right, and add on 115 pips. So in this case, the highs here, it's about 15550 plus 115, right? So pardon my math, right? My stop loss will be about 156.65. Okay, so let's put it at 156.65. Okay, they're about here. I'll change this to 156.65. Change this to rate so you know it's a stop loss. And there you have it, right? It's enough for you to kind of swallow this this fake out as the market reverses down lower again. So that's what I'm trying to share. Okay, another example, shall we? Euro Swiss franc. In this case, again, let's say, you know what? This one over here. Let's say this is again previous support turn resistance, and you want to short it because price at previous support, turn resistance, and maybe you look at this chart over here and it looks like a bearish engulfing pattern. Price might reverse lower, so you go short. Again, you can see that price dips up higher and then continues lower. So again, don't put your stop loss just above the highs. Use your ATR value in this case again, right? Just calculate what is the current ATR value. Let's say it's X. Okay, I'm just gonna, let's say it's X. Find out what's the highs over here. Then just take the highs plus X, and that is your stop loss. So you can give your trade, right, more room to breathe, so you don't get stopped up by all those spike up and down. This example is using 1 ATR, but again, if you want to be more conservative, you can use 2x, so basically 2 times the ATR. So your stop loss will be wider, but at the same time, you can swallow a deeper spike. The downside to it is that your position size will be smaller, so this means that your risk to reward ratio might not be as favorable. Alright, so this is something to bear in mind. Okay, so that's how you set a proper stop loss. And finally, how do you ride massive trends in the market? Okay, so ATR indicator, it's a volatility-based indicator, but at the same time, it can be used to ride trends in the market as a volatility-based trailing stop loss. So let's say, for example, let's look at just one market, Brent crude oil. Okay, let's look at let's say the weekly. So in this case, again, right, what you can do is that you see, let's say for example, the Brent crude oil, it's in a downtrend, prices break down lower. So you can actually reference the current ATR value, right, and set your trailing stop loss, right, a multiple of it. So let's keep things simple. At this point over here, right, let's say the ATR value is $4. And let's say you want to trail your stop loss, right? You don't want to, just exit the trade because the market could trend down even more. So what you can do is use a volatility-based stop, right, and use a multiple of ATR, and that's your trailing stop loss. So for example, let's say use 3 ATR as your trailing stop loss, right? This means 3 ATR is equals to $12. So from the lows over here, let's say the lows over here is this is $77. Okay, so your trailing stop loss will be at 77 minus 12, which is at $65. So this means, right, if the price it breaks, right, sorry, I should be adding, right, since this is a downtrend, right? So it'll be $89. 77 plus 12, $89. Okay, so if the price reaches $89, it breaks above it, right? This is where it hits your trailing stop loss and you exit the trade. So this is how you can actually use the ATR indicator to trail your stop loss, right? It's a volatility-based stop loss. So this takes into consideration, right, what is the current volatility of the market. If volatility expands, right, the trailing stop loss will accommodate it accordingly. So one little tip I have for you is that it can be tedious to manually calculate the ATR stop loss. So what you can do is you can use an indicator called the chandelier exit, chandelier stop, chandelier exit, whatever. Okay, just pull it out, and what it does is that it will, show you, right, the trailing stop loss based on ATR. So in this case, this pink line, right, is basically the volatility based stop loss that I've just shared with you earlier, that I've calculated with you earlier. Just that now you don't have to do the calculation. It's just plot out as a line for you. Okay, so you just click on this. You can see you can change the time period, the multiplier. If you want a larger stop loss, you can use, an ATR of even 6 ATR even if you want to. So you get more buffer on the trade. Okay, so I hope this is a useful indicator that you can use. One final tip that I have for you is that the larger your multiplier, right, the longer the trend that you'll catch. Okay, so let's say, for example, usually if you are using, 2 ATR, right, it's usually a short-term trend. 4 ATR, you're right, medium-term trend. And 6 ATR and above, right, it's usually long-term trend. So depends on your trading goal, right? What type of trends you want to capture, right? And you will use the respective multiplier on the ATR. But in this case, right, you can make your life easier by using the chandelier exit indicator, which is just a variation of the ATR indicator, but more for, trailing your stop loss. Okay, so with that said, wow, we've covered, quite a bit. So let's do a quick recap. Number one, how to identify, explosive breakout trades about to occur, right? If the weekly ATR is at multi-year low value, right, something big is about to happen. So watch the price action. If it breaks out of key market structure, right, you can use multiple time frame, right, to enter the trade, right, and potentially ride the big move. Number two, if the market has moved more than 1.5 times ATR into a key market structure like support or resistance, right, beware, right, is that the market could possibly reverse. So if you want to confirm the reversal, you can use, basic reversal candlestick patterns like shooting star, hammer, etc. Number three, you want to set your stop loss away from market structure. Don't just put it above the highs of resistance or below support. It's asking for trouble, right? I've shared with you that it's very easy to have your stops triggered. Instead, right, do this thing, right? Number one, identify the market structure, and number two, set your stop loss away from market structure. How much away? You can use the ATR indicator to help you with it. And finally, you can use the ATR indicator to ride massive trends in the market. To make your life easier, there's this indicator called the chandelier exit, right? It will perform the same thing as the ATR indicator, just that you don't have to manually calculate it. Okay, and right now, if you want to learn more about, what I do, my trading strategies and techniques, okay, you can go down to my website over here, tradingwithrainer.com, okay? Depending what you want to learn, trend following, then download this ultimate trend following guide. You'll learn how to, ride massive trends in the market and profit in bull and bear markets. Click this orange button, right, and I'll send it to your inbox for free. If you want to learn more about price action trading, support resistance, market structure, candlestick patterns, then this guide is for you, the ultimate guide to price action trading. Again, it's free. Just click on this, right, and I'll send it to your inbox for free. Okay, so with that said, I've come towards the end of this video. Enjoyed it? Hit the thumbs up button, subscribe to my YouTube channel below, and any feedback, comments, leave it below and I'll do my best to help. So with that said, I wish you good luck and good trading. I'll talk to you soon.